Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the financial statements of companies to uncover some really spicy secrets. Today we're looking at Banzai International Inc., and let me tell you, there is a lot more than just the surface level here, especially when it comes to recent funding events. So Banzai International Inc. has just released an important update, and it is all about a significant financial transaction that happened right at the beginning of 2026. This filing tells us about a fresh injection of money into the company through a private placement, specifically involving convertible notes and warrants. It's basically a way for the company to raise capital now and promise to deliver shares later, often with conditions. Now, let's get into what actually happened. The company Banzai International Inc. called it the February closing. This is where they issued an additional note, meaning they borrowed more money. This new note is for about $2.3 million and it comes with an initial conversion price of $1.11 per S-share. On top of that, they also issued warrants, which are like options to buy shares later at a set price. These February warrants allow the purchase of over 420,000 shares of common stock at that same $1.11 exercise price. This February note is set to mature in February 2027. Let's dig into the details of these notes a bit more. The February note, along with other notes issued previously, comes with an original issue discount of 10%. This means the company essentially receives slightly less money upfront than the face value of the note, which is a way to compensate investors for the risk. These notes also accrue interest at a rate of 10% per year. They mature 12 months from when they are issued, unless they are extended. Now here is where it gets interesting for investors. These notes are convertible into shares of the company's common stock. The number of shares you get depends on the conversion amount and the conversion price. However, there is a cap. The buyer cannot hold more than 4.99%, or sometimes up to 9.99% if they elect to, of the outstanding common stock at any given time. This is to prevent a single investor from gaining too much control too quickly through conversions. The conversion price for this most recent February note has a floor, meaning it won't go below $0.2540 per S-share, providing a safety net for the company. And what if things go wrong? The filing mentions an event of default. If that happens, the buyer has the option to convert their notes immediately, under different terms. This essentially means they could get more shares or a better price if the company hits a significant problem. The company is obligated to notify the buyer within 1 business day if such an event occurs, and if that is not enough, the buyer can also demand the company buy back the notes with a 15% premium. The company also has to make payments back to the buyer, starting from the 1st of August 2025, and then on the first trading day of every month until the note matures. The company is supposed to repay the buyer a portion of the principal, along with any accrued interest. This repayment can be in cash or, if certain conditions are met, in shares of common stock. This is a structured way for the company to pay back the loan over time. Now remember those warrants we talked about. They come with what is called a leak-out agreement. This agreement puts limits on how and when the buyer can sell their shares, especially those they might get from exercising their warrants. These limits are tied to the company's daily trading volume and are in place for a certain period. This is designed to prevent a large sell off that could tank the stock price. Let's talk a bit more about these February warrants. They are for over 420,000 shares, exercisable at $1.11 per S-share. These warrants are good for 3 years from when they were issued. But again, there is that beneficial ownership limit, usually 4.99%, which can be increased to 9.99% with advance notice. A cool feature here is that if there is a change of control, meaning the company gets bought by another entity, warrant holders have the right to receive the value of their warrants, calculated using a specific formula, and this can be paid in cash. The shares linked to these February notes and warrants are already registered, meaning they're cleared for trading. After deducting fees and expenses, the company received about $1.6 million from this February closing. They plan to use these funds for general corporate purposes and working capital, which basically means keeping the lights on and funding everyday operations. And who helped make this happen? Rodman and Renshaw LLC acted as the exclusive financial advisor. For their services, Banzai International Inc. paid Rodman a fee of 7% of the total money raised, plus a management fee of 1%. On top of that, Rodman or its designees received their own set of warrants. These financial advisor warrants are for about 133,770 shares of common stock, with an exercise price of $1.3875 per S-share. That exercise price is 125% of the offering price in this February closing. These advisor warrants are exercisable for 5 years. The company has also made some promises in their purchase agreement. They've agreed not to issue any more of these notes without the consent of the major note holders, and they can't issue other securities that would conflict with the terms of these notes or warrants. They also can't file other registration statements until the current one is effective. Plus, they've agreed not to do any variable rate transactions for a certain period, which are basically deals that could change the price or terms of their securities unfavorably. So, looking at this filing, it really shows us a company actively seeking and securing funding. The February closing on the 13th of February 2026 brought in new capital through convertible notes and warrants. This is a common strategy for companies, especially those looking to grow or needing funds for operations. The structure of these notes, with original issue discounts and conversion caps, is designed to attract investors while managing risk for the company. The inclusion of warrants is a sweetener for investors, giving them potential upside if the company's stock performs well. The leak-out agreement and the beneficial ownership limits are crucial details that show the company is trying to manage the potential dilution and market impact of these new shares. They are essentially balancing the need for cash with the desire to maintain stock price stability. From a Warren Buffett style perspective, we want to see if this financing strategy makes sense for the company's long-term health. Raising money through convertible debt can be good, but it can also lead to significant dilution in the future if the conversion price is reached. The original issue discount and interest payments are costs of capital. The fact that they're issuing warrants suggests they might believe their stock price has room to grow significantly, as these warrants only become valuable if the stock price rises above the exercise price. Now, the big question is whether this new funding will translate into actual business growth. The company states the proceeds are for general corporate purposes and working capital. This isn't the most exciting use of funds, but it is often necessary for smaller or growing companies. The key will be how effectively management deploys this capital. Are they investing in product development, expanding sales, or just covering operational shortfalls? We need to see future reports to understand the impact. A notable risk here is the potential for future dilution from the convertible notes and warrants, if the company's stock price does not perform as expected, leading to conversions at unfavorable prices for existing shareholders. However, an opportunity lies in the potential for Banzai to leverage this capital to drive significant revenue growth and market expansion. Alright, that is our breakdown of Banzai International Inc. Latest filing, what is your take on these numbers and what they signal for the company's future? Do you think this financing strategy is smart or risky? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community discussion. Thanks for watching, see you next time.